Last week there was an article that was published on Bloomberg regarding a really interesting trend about where more investors have been putting their money. In 2025, roughly 1 out of every $6 invested in an ETF was put into a higher yielding fund. ETFs offering a yield of at least 8% have seen their assets quadruple in just the last 3 years, to now over $160 billion. The biggest reason why people are now flocking to these higher-yielding dividend investments is because they simply want to retire early. It's a trend that's becoming more popular, and even among younger investors who are more motivated by high dividend payments than share price growth. Since 2020, I've been covering the higher-yielding investment types on this channel and Patreon and have been preaching the high-yield gospel, that you don't need millions of dollars to live off dividends, unlike what you would typically need to live off lower-yielding stocks like Coca-Cola and Procter & Gamble. As more people flock to income investing, there's undoubtedly a lot of questions that these new investors have, like what types of investments are dependable? What ETFs out there would be good candidates to retire early off of? In this video, I'm going to highlight some suggestions that would be good considerations if you're in the process of constructing your own high-yielding dividend portfolio for the sake of retiring early. Likewise, these would also be worthy considerations if you're already at or close to retirement and you want to invest for high income. To start things off, if you want to retire off dividends, there's a few things that you need to keep in mind when constructing a high-yield dividend portfolio. When picking ETFs to invest in, they should meet the following criteria. Obviously, they need to provide a high yield. If you consistently save and invest, it can still take decades to acquire the millions of dollars necessary to live off dividends from lower-yielding investments like Johnson & Johnson. The investment should also pay dividends monthly or more frequently. The majority of dividend-paying investments that exist do issue dividends on a quarterly basis. There's nothing wrong with an investment that pays quarterly dividends. I hold plenty of quarterly paying stocks myself. But I would prioritize the monthly payers since you'll be receiving a paycheck every month as opposed to once every 3 months. The dividends paid by these ETFs should be either growing or remaining very consistent. You have to check and make sure that the dividends being paid out by these funds aren't going down over time. You can go on any financial website like Seeking Alpha or Yahoo Finance and see the dividend history of a holding that you're interested in. If an ETF's dividends are only going down over time, then that's not a good holding to entrust your financial future with. Ideally, the fund should also be well diversified. Everyone's going to have their own preference in terms of how diversified an ETF should be. I personally would like to see at least 20 or 30 holdings inside of each ETF. There's a number of covered call funds that mirror an entire index, and those are always well diversified. The more holdings an ETF has across many different sectors, the safer it usually is. So with that being said, those are some of the parameters we're going to look at when picking high-yielding funds for our portfolio. An ETF doesn't have to meet all of these requirements perfectly for me to consider it, but I would say it's most important to not see dividend payments consistently falling over time. But if you can find an investment that meets 3 of the 4 criteria, then that might be a good sign that what you're looking at is a solid candidate. And with all that out of the way, let's look at some ETFs that would be good considerations. The Virtus InfraCap US Preferred Stock ETF, ticker PFFA, is an ETF that holds a pool of preferred stocks. These are investments that are similar to common stocks, but they function more like bonds. In terms of dividend priority, if a company wants to pay a dividend to common shareholders, they first have to make sure that preferred shareholders are paid first. They're also higher in terms of priority if a company goes bankrupt. If there's anything left over after a company liquidates their assets because of a bankruptcy, then preferred shareholders are more likely to receive some of their investment back than common shareholders. That makes preferred stocks safer than common stocks, but PFFA adds risk by using leverage. So it takes a safer investment and adds some risk to it in order to boost its monthly dividend. With that in mind, it's not a risk-free investment. But PFFA has consistently offered a high monthly dividend, and preferred stocks stand to gain when we do get interest rate cuts. There's a number of covered call ETFs that provide high monthly income, with some of the best being by Neos in my opinion. The Neos S&P 500 High Income ETF, ticker SPYI, is becoming the gold standard among index covered call funds. It's consistently offered a dividend yield of well over 12% and it pays distributions monthly. Covered call ETFs are funds that use a strategy of selling call options on the index they're exposed to generate income for shareholders. The strategy involves holding a collection of securities and then selling call options on those securities, thus collecting a premium that's passed on as income. They're easily becoming the most popular type of high-yielding investments available because all of them pay monthly or even weekly in some instances, and they offer some of the highest yields available. A similar fund to SPYI is QQQI, which is the NEOS Nasdaq 100 High Income ETF. As the name would suggest, this one is the same strategy as SPYI, but only for the Nasdaq 100 index. This fund offers a yield that's higher than the S&P 500 fund, but it is on a riskier index. There are some alternatives to QQQI that exist and are even worth considering in addition to QQQI. I hold a couple of covered call funds for the exact same index, and people will sometimes ask me if I'm concerned about being overexposed to the same group of stocks. And my response has been, I'm fine with holding multiple covered call funds for the Nasdaq 100 or any index if they have different enough strategies. Because I would argue that when it comes to diversification, it's not just about the underlying stocks, but the strategies they use. Another solid fund is GIPQ by Goldman Sachs. Again, this one has also done really well on the Nasdaq 100. It does offer the lowest yield out of everything we've looked at so far, but it does offer better share price appreciation. A covered call fund that's still worth considering, but it's not an index CC fund, is the JP Morgan Equity Premium Income ETF, ticker JEPI. What makes this fund unique is that it holds equity-linked notes, which are supposed to make it a less volatile investment. Unfortunately, it doesn't offer great share price or dividend growth because of that more conservative strategy, but it has grown a little bit. Also, the dividends paid by JEPI are a little more tax efficient because part of them are considered qualified. There's another covered call fund that isn't directly based on the Nasdaq 100, but it does primarily hold a lot of the biggest companies in that index. QDVO, which is the Amplify CWP Growth and Income ETF, seeks capital appreciation from growth-oriented stocks with high monthly income from option premiums and dividends. Going through a selection process, they select between 20 and 40 stocks that they believe are well positioned to see growth, and then they use tactical covered calls on those positions. It's been a really good fund up to this point. Even though it's less diversified, they seem to have a really great selection process. So that's going to wrap up our look at some well-built ETFs that offer high yields, consistency, oftentimes growth, and diversification to help build a high-yield dividend portfolio. Feel free to check out some of the other videos on this channel, which is entirely dedicated to high-yield investments. Be sure to do your own research before investing in any of these positions, because some are riskier than others. If you have any ETF suggestions yourself, then feel free to leave a comment below. But with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.